Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribe, like, and comment underneath. And definitely check out the VIP Algos link right below in the description.
Yeah, that VIP Algos tool is, especially helpful when we're looking at these highly volatile tech plays. It really helps you cut through the noise.
Exactly. And I mean, there is a lot of noise right now when it comes to who is actually making money in this AI boom.
Oh, absolutely.
Like, if you want to find the real wealth building context here, you have to forget the software coders for a minute. You have to look at the companies that are literally pouring concrete and buying up gigawatts of electricity.
Right. It's the 1849 gold rush all over again.
Yeah. I mean, most of those historical miners, they went absolutely broke. But the people who built generational wealth, they were the ones selling the pickaxes and the blue jeans.
The infrastructure providers.
Exactly. And today, you are living through the exact same dynamic, except, these modern pickaxes, they cost billions of dollars and require enough electricity to power a small country.
Yeah, the scale is entirely different now, but that foundational business model, it really hasn't changed in a century and a half. The infrastructure guys, they simply do not care if a specific AI software startup succeeds or fails.
No, not at all.
They just know that you cannot even enter the race without buying their shovel first.
Which brings us to the fundamentals of Nebius Group, ticker symbol NBIS. We've got a stack of financial reports and live market data in front of us today, and the goal is to figure out how this company balances just mind-boggling revenue growth with massive physical liabilities.
Right, and to understand why the market is tolerating those liabilities, we really need to look at their Q1 2026 financials, because honestly, they completely break the mold of traditional hardware economics.
I was staring at these numbers this morning, and I honestly thought they were typos.
They're pretty wild.
Like, for Q1 2026, Nebius Group posted revenue of $399 million. That is a 684% jump year over year.
It's massive.
And if you drill down into just their AI cloud revenue, that exploded by 841%.
Wow.
But the stat that actually made me stop reading and do a double take is their net margin, 93.09%.
Yeah, a figure like that in an infrastructure business is... it's practically unheard of. If you are laying cable or racking servers, you're usually fighting tooth and nail for single-digit margins.
Right.
So seeing a 93% net margin alongside a trailing 12-month gross margin of 72%, it tells a very specific story about leverage.
So explain how that actually works under the hood for us. Because, when you hear a 93% net margin for a company buying physical hardware, your first instinct is to assume there's an accounting trick, right?
Sure, yeah.
Like, how physically and financially does a hardware company achieve margins that look like a pure software as a service business?
It fundamentally comes down to monetizing extreme physical scarcity. If you think about the mechanics of their business, they buy the highly coveted AI chips, they build the data centers, and then they lease that computing power out. But because there's just this insatiable demand for AI compute, right, and a severely constrained supply, they aren't just charging a standard markup.
They're charging a premium.
A massive software-like premium. And customers are often paying upfront just to secure access to the servers. So when your customers are willing to prepay or sign massive long-term contracts at these high prices just to guarantee they don't fall behind in the AI race, well, your operating leverage just goes through the roof.
Right, because the concrete and steel, those are fixed costs.
Exactly. The fixed costs are covered, but the revenue potential from that infrastructure is priced at this crazy premium.
And the financials definitely back up that idea of long-term lock-in. Nebius currently has a $50 billion contracted backlog. $50 billion.
Yeah, and that specific term, backlog, it's crucial for anyone looking at the stock to understand. In a lot of tech companies, a pipeline or a forecast is just a sales team's optimistic projection.
Right, just wishful thinking.
Exactly. But a contracted backlog is completely different. These are legally binding, long-term customer commitments. Many of these are what the industry calls take-or-pay contracts.
Meaning the customer pays for the server time, whether they actually run their AI models or not.
They do, yeah. It means $50 billion worth of revenue is essentially locked in. Nebius just has to physically stand up the servers and deliver the computing power over the coming years to recognize that revenue on their income statement.
But wait, everyone is begging for the chips to build those servers right now, right? I mean, the ultimate bottleneck in this whole industry is the GPU, the graphics processing unit.
Oh, absolutely.
And NVIDIA is the undisputed king of those chips.
Yeah.
So if everyone is fighting for the exact same hardware, what makes Nebius special? How are they getting to the front of the line to fulfill a $50 billion backlog?
Equity. NVIDIA actually holds a stake in Nebius.
Oh, wow.
Yeah, they aren't just a customer standing in line. They've been elevated to what's called a reference platform cloud partner in the NVIDIA network.
So it's a symbiotic relationship then. NVIDIA isn't just selling them hardware. They have a vested financial interest in seeing Nebius succeed.
That relationship fundamentally changes the procurement dynamic. When there is a global shortage of the chips needed to train these massive AI models, Nebius essentially gets to skip the line.
Because NVIDIA wants them to win.
Exactly. NVIDIA wants to cultivate independent, high-performance cloud ecosystems so they aren't entirely reliant on just Amazon or Google, you know?
Right, that makes sense.
So by granting Nebius priority access to these scarce GPUs, Nebius stays structurally ahead of rival cloud providers. Those rivals are just left fighting for whatever chip allocations are left over at the end of the quarter.
I see the logic there, but I have to push back a little on the terminology we keep using here. Nebius, AI, cloud computing, cloud revenue. When you and I hear the word cloud, we naturally think of software, right? We imagine data floating in the digital ether, totally decoupled from the physical world.
Yeah, the invisible cloud.
Right, but these reports keep hammering on about physical land, transformers, and power grids. So if this company's massive growth is coming from cloud revenue, why does physical dirt and electricity matter so much?
Well, the cloud might honestly be the greatest marketing illusion of the modern internet era.
Really?
Yeah, the cloud is not in the sky. The cloud is just somebody else's very loud, very hot, extremely expensive physical computer. And it lives in a massive fortified warehouse made of steel and concrete.
And I imagine it requires a staggering amount of resources to keep it running.
Oh, it does, which is the core bottleneck of the AI revolution right now. The limitation isn't just getting the NVIDIA chips out of the factory. It's having a physical location to plug them in.
Yeah.
You need heavy-duty cooling systems, reinforced floor space, and most importantly, you need massive, uninterrupted streams of electricity. If you look at the data center vacancy rate in North America has collapsed to a historic low of 0.9%.
Less than 1%. So essentially, there are 0 empty buildings left on the continent that possess the necessary power and cooling infrastructure to house these servers.
None at all. Any facility with a heavy-duty grid connection is already spoken for. And this is the secret to Nebius' strategy. They aren't just buying chips, they're executing an aggressive physical land grab.
Right.
They've successfully locked down 3.5 gigawatts of total power capacity.
Okay, let's give that number some context for you listening. 1 gigawatt can power roughly 750,000 standard homes. So securing 3.5 gigawatts means they have locked down enough electrical capacity to power over 2.5 million homes.
It's massive.
That is the energy footprint of a major metropolitan city just for their servers.
Yeah, and out of that total 3.5 gigawatts, they have secured 1.2 gigawatts of power and the associated real estate, specifically for a massive new AI factory in Pennsylvania.
Wow.
So to answer your earlier question about why dirt matters, you simply cannot run an AI cloud without gigawatts of electricity. And you cannot get gigawatts of electricity from the local utility without securing the physical land, putting down substations and locking in grid connections years in advance.
So Nebius is winning because they recognized early on that the future of the cloud is actually made of heavy steel and high voltage power lines.
Exactly.
But, securing 3.5 gigawatts of power isn't just a matter of signing a contract with a local utility. It requires pouring concrete, laying lines, and frankly, bleeding cash.
Oh, yeah.
And when you look at their balance sheet, you see the sharp edge of that physical reality. I was reviewing their liabilities, and it terrified me at first glance. They are carrying a $15 billion liability load.
It's a big number.
Yeah. Just in Q1 of 2026 alone, they burned through $2.47 billion on property, equipment, and assets. I mean, if you're a traditional value investor looking at that kind of quarterly cash burn, you're running for the hills. Is this reckless spending, or is there a floor to this risk?
It is a capital-intensive blood sport right now, but from an infrastructure perspective, it's entirely necessary. They are prioritizing growth reinvestment over short-term capital returns.
So no dividends.
No, you won't see them doing share buybacks or paying dividends anytime soon. And honestly, they shouldn't be. In this specific land grab phase of the AI cycle, if you aren't spending billions to build data centers today, you literally will not have a business tomorrow.
And the technicals show the market is definitely pricing in that hypergrowth narrative. Let's look at the stock itself because it is the textbook definition of high beta and volatile.
Very volatile.
For anyone tracking these metrics, a high beta stock means it exaggerates the market's movements. So if the broader market dips, Nebius drops harder, but if the market rallies, Nebius takes off like a rocket. At the time of this market snapshot, it was trading around $215.62, which was down about 5.9% for the day. But over the last 52 weeks, it boasts a 331.5% return.
Yeah, that kind of year-over-year gain is astronomical, but it also pushes the stock into a premium valuation territory. Their price-to-earnings ratio, trailing 12 months, sits at 66.40, and the price-to-sales ratio is 61.81.
Let's break that price-to-sales number down, because a PS of almost 62 is wild. That means investors are willing to pay $62 today for every single dollar of revenue Nebius generates.
Right.
They aren't pricing in current reality. They're pricing in a flawless future where every ounce of that 3.5 gigawatts is monetized perfectly.
Exactly. The market is assuming flawless execution of that $50 billion backlog. Any operational delay in bringing those Pennsylvania data centers online could severely punish a valuation that high.
And the trading volume reflects that intense focus. The data points out that over just 2 days in early July, 24.9% of Nebius's Class A shares changed hands. A quarter of the company's available shares traded in 48 hours. What does that actually look like under the hood?
Well, when you see 25% of a stock turnover in 2 days during a price dip, you are not looking at retail investors day trading on their phones. That represents massive institutional repositioning.
What the market calls whale accumulation.
Exactly that. Large funds and institutional investors are taking advantage of a minor price dip to accumulate massive positions. They're looking at the 3.5 gigawatts of secured power. They understand the depth of the NVIDIA partnership, and they are aggressively buying into that physical moat because they know how hard it is to replicate.
I have to throw a red flag on the play here, though. Looking at the sentiment, the data also notes a pattern of recent insider selling. If this company has a $50 billion backlog, priority access to NVIDIA chips, and institutional whales are hoovering up the stocks, why are the actual insiders cashing out while the going is good?
Yeah.
I mean, if I'm an executive at a company that is about to conquer the AI infrastructure world, I'm holding on to every single share I have.
Yeah, insider selling is traditionally viewed as a bearish signal, so your skepticism is warranted. But you have to contextualize this specific stock's performance. It is up 331% over the past year.
True, the appreciation has been massive.
Put yourself in the shoes of an executive there. A massive portion of your personal net worth is tied up in this single company. When your stock quadruples in value in 12 months, selling a portion of your holdings isn't necessarily a panic dump, and it doesn't automatically signal a lack of faith in the company's future. It is often just prudent wealth management. You sell a fraction of your shares to diversify your portfolio, maybe buy real estate or pay taxes.
Just taking some chips off the table so you aren't completely exposed to one asset.
Precisely. And when you pair that natural profit-taking with the heavy institutional accumulation we just discussed, the whales eagerly buying up the shares those executives are selling, it paints a picture of a healthy market transfer rather than a mass exodus by management.
Okay, that does make sense.
Yeah.
But let's look at the risks, the bear case here. Because if the institutions are actively accumulating and the physical moat is as impenetrable as we say it is, what caused that massive volatility? You mentioned a dip earlier, but the financials show there was a recent, sharp 12.4% single-day drop.
Right.
What headlines spooked the market that badly?
That brings us directly to their primary risk, which revolves around a single massive competitor.
Meta platform.
Yes. That 12.4% drop was triggered by a Bloomberg report suggesting that Meta is in the process of setting up its own commercial cloud business.
Oh, wow.
Yeah, they are reportedly looking to sell extra unused AI computing power from their internal data centers to outside clients.
So they're transitioning from being just a consumer tech and social media behemoth into a direct infrastructure provider.
Exactly.
And to understand why that terrified Nebius investors, we have to look at Nebius's customer concentration risk. This is the part of the data that really made me wince. We talked about how incredible that $50 billion backlog is, But 86% of that backlog, which is an amount roughly equal to their entire market cap, relies on just two massive players.
It is a very precarious balancing act.
They hold a $19.4 billion contract with Microsoft and a staggering $27 billion contract with Meta.
Yeah. So if Meta decides they don't just want to build their own internal AI infrastructure, but they actually want to turn around and sell it to the broader market, they transform overnight from Nebius's most lucrative customer into Nebius's most dangerous competitor.
The analogy that came to mind when I read this was real estate. Imagine a landlord who owns a massive 50-bedroom mansion. They rent the entire property out to one incredibly wealthy tenant for a fortune. Life is great. But then, that tenant decides they only really need 10 bedrooms, and they start subletting the other 40 rooms on Airbnb to tourists. Suddenly, the tenant is running a competing hotel business out of your own property. If you're Nebius, relying on Meta for $27 billion, that Bloomberg report is the headline that keeps you up at night.
Oh, without a doubt. The loss, or even just a forced renegotiation of a $27 billion contract would be catastrophic for a company carrying $15 billion in liabilities.
But there is an unconfirmed market rumor regarding that specific Meta contract that kind of twits this whole narrative around.
Yeah, the rumor mill suggests that a $15 billion portion of the Meta contract, which is classified on the books as extra available capacity, might actually be sold off or subleased to other mid-sized AI cloud clients.
Wait, so instead of Meta just walking away or directly competing, they might broker that capacity to someone else through Nebius.
That is the chatter. And ironically, if that happens, it could profoundly strengthen Nebius's underlying business.
How does losing direct utilization from your biggest client help you?
Because it forcibly solves their biggest vulnerability: diversification.
Ah.
Think back to your mansion analogy. If that $15 billion block of computing power is suddenly being utilized by 20 different AI startups instead of just Meta, Nebius's revenue base becomes significantly broader and healthier. They still get paid for the capacity, but they ironically reduce the very customer concentration risk that had investors panicking in the first place.
That is a fascinating way to look at it. You spread the risk across 20 startups instead of one tech giant. But even setting the subleasing rumors aside, how much of a fundamental threat is Meta, really? If Meta successfully builds their own commercial cloud, is Nebius doomed?
Well, this circles us right back to our central theme, right? Physical scarcity. Even if Meta goes all in on building internal infrastructure to sell, global demand for AI compute outstrips supply so aggressively right now that it almost doesn't matter.
Because there literally isn't enough power on the grid to go around.
Exactly. Meta can have all the corporate ambition in the world, but they cannot magically manifest gigawatts of grid capacity out of thin air. Physical infrastructure takes years to permit, build, and energize. Nebius already holds the land. They already tap the power grid. They already have the priority access to NVIDIA GPUs.
Right.
That 3.5 gigawatt capacity remains an incredibly valuable, irreplaceable asset, completely regardless of Meta's internal strategy.
Let's synthesize all of this for the final verdict. We have incredibly bullish momentum, a massive $50 billion backlog, but we also have severe concentration risks and a cash-burning CapEx strategy. If you're watching this stock, what specific catalysts should you be tracking over the next few months?
Well, the primary event on the immediate horizon is their Q2 2026 earnings release coming up in August.
And what metric are we zeroing in on there?
Conversion. We need to see if that $50 billion backlog is actively converting into recognized revenue. It is one thing to have a signed take-or-pay contract. It is an entirely different operational challenge to physically deploy thousands of servers, get the cooling systems online, and start billing for compute cycles.
Right. Execution is everything.
We need to see that physical conversion happening on schedule.
And beyond the concrete and steel, we also need to keep an eye on how they are upgrading the software layer. They recently launched AI Cloud 3.6, which features a tool called Nebius Echo.
Yeah, Nebius Echo is a natural language controller designed for their cloud infrastructure.
What does that actually look like for the developer sitting at the keyboard?
Historically, provisioning cloud servers requires writing complex code, managing API calls, and manually configuring environments. It's tedious. Nebius Echo abstracts all of that away.
Oh, nice.
Yeah, a developer can essentially type everyday language into the system, something like, I need 500 H100 GPUs optimized for a PyTorch training run spun up by Tuesday, and the system automatically provisions the infrastructure.
That's incredible.
Tracking the adoption rate of that specific tool will tell us if Nebius is successfully innovating on the user experience, or if they are just destined to be a dumb pipe providing raw power.
Bringing it all together, What is the final score based on the data?
The financials point to an 8 out of 10 bullish score, viewing it as a strong multi-year view. But of course, that's not financial advice.
No, absolutely not. But with a massive multi-billion-dollar caveat attached, right?
Exactly. The entire thesis only holds up if Nebius can flawlessly execute their CapEx strategy. They cannot afford permitting delays in building those Pennsylvania data centers, and they cannot afford hiccups in their GPU procurement from NVIDIA. A price-to-sales ratio of 62 does not forgive operational blunders.
Definitely not.
But if they do execute, the leverage from their gigawatt-scale capacity is immense.
It is a high-wire act, but their safety net is the fact that they literally own the wire, the building it's attached to, and the power plant feeding it. Which leaves me with a final thought I really want you to mull over as we wrap up today. Throughout this talk, we've talked about AI as this limitless, constantly expanding digital frontier. But Nebius's entire business model proves that artificial intelligence is fiercely bound by the physical world.
It's heavily tethered to physical limitations.
Nebius is locking down 3.5 gigawatts of electricity just for their own facilities. Tech giants across the globe are attempting to do the exact same thing. So what happens when the physical power grid simply cannot support the energy demands of the AI economy? We spend so much time debating whether silicon chips can keep getting faster or whether the software code will achieve artificial general intelligence. But the ultimate bottleneck for the future of AI might not be NVIDIA or Meta or some genius coder in a basement.
It might literally just be your local utility company's ability to keep the lights on.
It's like the 1849 gold rush all over again. Levi Strauss made a fortune selling blue jeans to the miners. But what happens to the boom when the world completely runs out of cotton?
That's the real question.
Well, that's all for today's analysis. As always, if you found this useful, please remember to subscribe, leave a like, and drop a comment underneath.
And don't forget to check out the VIP Algos link down in the description for more tools to track these markets.
Thanks for listening, and we'll catch you next time on Smart Wealth with Joshua.